Hello, everyone. My name is Majesty. I am an Atlanta-based real estate developer with 13 million in assets under management and another 50 million in the pipeline. I build and rehab apartment buildings, so stick around for some real estate information. I'm doing a series on 100 questions that I get asked pretty commonly in real estate from people that want to get involved. So I'm answering them one day by day. And today's question is, what are the risks associated with real estate investing? Like what are the possible pitfalls, downfalls, things like that. Every investment has them. So you just kind of gotta leverage or kind of protect yourself against that. But I'll go through some of the like more technical ones, but then I'll go through some, more personal kind of experience based ones that I use and stay on top of in my activities. But um, so I would say the first one is just basically like risk involving the market in general. Um, and that's kind of bigger than whatever transaction you're working on. For example, market changes like the interest rates. That's a big one for everybody, commercial or residential. It affects what you're able to do, no matter kind of like what the deal looks like. You have to structure it and restructure it to fit what the current market will kind of allow. So that's a challenge there. And then you have economic downturns. Some of them you can foresee, some of them you can't. Like we had a shutdown, we had a pandemic where things kind of happened overnight. So those are some of the concerns that you can't do as much about, but you do need to kind of prepare yourself to deal with if you want to be successful. There's also risks that are location based, like where the property is situated. You think about Monopoly, you pay a lot more for the Park Place than you do for, I don't even know the name of the first one that you come across with the Brown. So it's like, you have to take the good with the bad with all of the properties that you have, because Park Place is very expensive. So there's pros and there's cons to everything. But location is very important. Bad locations, you have crime, you have instability. In the better locations, you have just high cost, things like that. So, and then there's also property specific type risk, and that's specific to the property, unlike the market risk is kind of, you know everybody, everything. But the property specific risk might be something like deferred maintenance. Maybe they haven't changed the roof out in 30, 40 years. Maybe they've just had bad management in place, and things have kind of fallen apart, have been allowed to. So that's more of like a property specific risk. And kind of to mitigate that, though, you got to inspect. You got to make sure you screen everyone, including vendors and tenants, well. And then you have to just basically catch up maintenance. So you need a real good maintenance capex plan to kind of bring things together, or what have you. And there's some more risk. The other risk would be financial, I guess. You would say that the risk of borrowing money. Most people are borrowing money to buy real estate. This kind of goes back to the interest rate issue, which they'll be dropping them soon. Fingers crossed. But ultimately, the financial risk will affect your cash flow, which will affect your ability to be able to kind of maintain the property, or to sustain ownership of the property. So to mitigate that, though, you just have to try to get the best financing that you can get in regards to interest rates and terms, and things like that, fees, and kind of expectations. Some of the money comes with compliance, like you have to do certain things after you get the funding for the project. So you want to consider all of that, because the costs are involved with that. Also, you want to make sure you have plenty of cash reserves. That's very important in real estate, is to have several months of reserves, sometimes up to a year, even more than that they'll require. And then you just got to budget. You got to really be good with your underwriting, really tight. Get all your third party reports, And there's always going to be risk, but you try to do as much up front to mitigate those risks. And then you have legal type risk, and that also is a little bit above a project level, kind of issue. For example, zoning. That's a big issue in a lot of different areas. Trying to change the zoning to allow more different types of structures to be built without having to rezone, which is a very tedious and expensive and just it's a horrible process to have to go through, but it's necessary. But that's an example of a legal or regulatory risk, and also disputes with vendors or anybody that you work with on the property. For example, you have tenants, any liabilities there when it comes to insurance. That can become a big issue as well. So I mean, you mitigate that by just trying to stay on top of things, staying informed, but mostly by having great attorneys by your side that you can go to for counsel and to take care of things when they happen. That's really the best way to kind of mitigate that one is attorneys. And then you also have risk with the environment, and I mean specifically like environmental natural disasters. Some properties are in floodplains, different things like that. Maybe they have asbestos. They have, radon testing, the lead paint, mold, things like that are literally the environment affecting the property. You have to be aware of those. In fact, for most federal funding that I'm aware of, you have to do an environmental review, which is where the funder that is giving you, the capital for your project, will require a third party to kind of inspect the project pretty intensely to make sure that it doesn't have negative environmental effects, or what have you. So it's a very important thing, especially with the government, which makes sense. They want to protect their constituents and such. And another one would be liquidity risk. You just cash management is very important in this. You have your revenue coming in. However, whether it's you're renting it out or you're selling it, but at the end of the day, you have very high expenses as well. So you just have to be able to manage that and make sure that you don't run out of money before the month ends or before the project ends. It happens very often. And things can happen in the market too that shifts and kind of messes with your reserves. You had 3 months reserves, but now you need 6 or 9 or a year or 2 years, like with the COVID issue and moratoriums and all of that. So the best way to kind of deal with that is just to try to be as liquid as possible. Try to keep your properties not super leveraged in the sense that you have a $1 million loan on a $1 million property, because you can't really use it as an asset to get any equity out of, or to do anything with, to bring partners into there's no more pie to share, if you will. So you want to kind of try to keep the equity somewhat attractive. And your exit strategy is important when it comes to that as well. You just got to always plan for your exit strategy, and then operate your plan based on your exit strategy. And a few more risks that are more, I would say just kind of my way of saying things, or my way of looking at it, not so technical, is overpaying is probably one of the biggest risks. If you overpay for the property based on your exit strategy, like your business plan is not going to work, and it kind of doesn't matter, or the environmental, the rate, interest rates, all of that. I mean, it was going to go down either way. Those things might make it happen quicker, but overpaying is a problem, and that's why they say in real estate, you make your money when you buy. Like the day that you buy is when you make your money, and it depends on how you buy. And not to say that you should just lowball everybody, but you definitely do not want to overpay for property. That'll cause a lot of problems. And another one I'd say is just bad choice in whoever you choose to either manage or the property or the project. So if you're doing a construction project or rehab or something, like GCs are unfortunately notorious for messing up projects and kind of killing them, and kind of taking that rehab budget and for whatever reason not executing all the way, and then leaving the investor with the issues. So that's pretty common, unfortunately, and that's a really bad. So you got to select, you got to be very very strict with your selection. Typically do it by referral. You want to see people's work that is done. Contracts are very important. Make sure you have contracts, and very like tight knit contracts, not just something written on a piece of paper or some handshake deal or something like that. Put it on paper. And the same thing I'd say with management, property management. If you're going to buy a rental, they can that can go wrong, as well as they can overcharge you for things, or they could just be negligent. They don't get paid a lot, to be honest with you. They get typically about anywhere between about 5 to 10% of the rent that comes in. And if you're only getting 1,500 a month in rent at a house or something, then that's not that much money to have somebody be dedicated to your property and making sure that it's operating like at its maximum level of efficiency. So that's one of the benefits of having multi units and things like that, is being able to give them more. But that's another risk. And the final risk I'll mention is being forced to sell prematurely, and that kind of speaks to some of the previous ones when it comes to cash management. When anyone that loses money in real estate, and this is my opinion, and this is also my experience, but anyone that loses money in real estate just had to sell sooner than they should have. Because if you're able to hold real estate, like the people that held through the 2007 2008 financial crisis, they did fine. It was a blip, on the radar. It just, I mean, the values go down, but if you're not selling, then it doesn't really affect you, and then the values come right back up, and then they actually go above where they were. So the people that held on to that through that time, they're doing great. The people that got hurt are the ones that had to sell. So that's probably, I would say probably the biggest risk is just having to sell before you're really ready to, and before your business plan indicated that you would. But anyway, those are some of the main risks. At the end of the day, I still feel that real estate is the strongest asset out there, and that no other asset can hold a candle to it. And feel free to take me up on that debate. In the meantime, just make sure that you like, share, comment. Please leave your questions and experiences in the comments. I'll be glad to, kind of respond and listen to what you guys have to say as well. So I appreciate you checking out this video, and until next time, bye.